Did you know that billionaire Andrew Carnegie said 90% of all millionaires become so through owning real estate? More money has been made in real estate than in all industrial investments combined. The wise invest their money in real estate. So if investing in real estate has aroused your interest, then you're probably wondering how to turn that curiosity into a lot of money through real estate. The advantage of investing in real estate is that virtually anyone can start this type of business. With the right tenacity, you can grow significant riches without waiting a lifetime for your money to multiply. So, the primary purpose of creating a wealth generator is to search for, plan, and put into action a dependable route to growing your money while simultaneously freeing up time through the generation of passive income. So, what is passive income? Well, this thing called passive income is money that you earn without putting too much ongoing effort. Welcome to Money Talk, where we discuss everything related to money. But before we begin, don't forget to hit that like button and click subscribe. So there are just a few different types of investments that can supply all four types of wealth generators, with real estate being the type of investment that is the most reliable and consistent. So let's start with the first one. The first one is called a cash flow. So cash flow is the additional profit generated by an investment property after all of the expenses associated with that property have been made. My cash flow for the month would be $300 if, for instance, the income from my rental property was $2,000 and my expenses came to $1,700. In addition, that $300 may have come from a single piece of real estate. So if I had 10 properties of the same type, each producing the same cash flow, my monthly income would be $3,000. If I had 100 units, then my monthly payment would be $30,000. This income flow can be a significant factor in determining whether or not you can quit your career, save for a necessary future purchase, or retire with more wealth. Next is number 2. So at number 2, we have appreciation. A rise in real estate values is what I mean when I talk about appreciation. So for example, if you paid $200,000 for a house 10 years ago, and it is now worth $300,000, the appreciation has made you $100,000 richer. So obviously, appreciation does not always increase values. I mean, just look at what happened in 2007. However, throughout history, the prices of real estate have, on average, increased over time. Therefore, appreciation is not likely to make you a millionaire. So I do not propose that people purchase poor bargains in the hope that appreciation will bail them out of their predicament and make them rich. So at number 3, we have the loan paydown. Suppose you finance the acquisition of a rental property with a mortgage. In that case, the lender will accept payment from you every month. This payment covers 2 aspects. So these 2 aspects are the principal as well as the interest. The interest is charged on the loan is the profit made by the lender, while the principal is the amount of money used to reduce the balance of the loan. So if you acquired a home 5 years ago of the price of $100,000 and obtained a 30-year mortgage of $80,000 with a fixed rate of 5%, the amount you owe on the home today is only $74,000. A decade from now, your debt would be reduced to $65,000. This indicates that you would gain value every year that your equity increased, with equity being the difference between what a property is currently worth and what is still due on it, as long as the property's value didn't decrease. And at number 4, we have the tax benefits. So the tax incentives that the government of the United States provides to investors are the 4th factor contributing to the generation of wealth in the real estate industry. These benefits are extensive, and they can be reaped in various different stages of the property buying and selling process. So hear me out now about the benefits. Contrary to most businesses, the government does not consider cash flow or appreciation to be self-employment income, so there is often no need to pay self-employment tax. Second, the amount of income tax that is owed can frequently be ultimately canceled out by depreciation deduction. Third, if you make a profit when you sell a rental property, it is taxed at the rate of long-term capital gains. That is, if it is taxed at all. Lastly, a 1031 exchange, offered by the government as a mechanism to trade up to more extensive or better properties, can typically defer taxes. So how does this all fit together? In their own right, these money generators can be mighty powerful. The synergy between the four, however, can make you extraordinarily wealthy. To get an idea of how this works, you might put down $200,000 on a piece of multifamily real estate that costs $1 million and acquire it with that sum. Let's say this property generated a cash flow of $30,000 annually. That's annually, okay? Still, it was also potentially appreciating value at a rate of 5% annually. This indicates that after 10 years, it may be worth $1.6 million, and you may have received an additional $300,000 in cash flow during that time. In addition, if you pay off the initial property in 10 years, you'll owe only $650,000 and have a net worth of $1 million from that asset alone. And as a bonus, the tax advantages of that decade would allow you to keep substantially more of your profit than you would have made otherwise. Becoming a millionaire through property investment is achievable. Planning, it can take some time, but you should also be aware that you have the power to make it happen. Gaining the appropriate knowledge, formulating a strategy, and keeping to that approach to achieve your goal are all critical parts of achieving success in this field. If you enjoyed this video, make sure to hit that thumbs up button, click subscribe, and hit the notification bell to receive updates on our latest videos. See you! Did you know that billionaire Andrew Carnegie said 90% of all millionaires become so through owning real estate